Because venture capital, unlike trading, it's not a single player game, right? Venture capital is a multiplayer game at its essence, right? You're usually on a team and you win by helping people, and you only win if other people win. The other thing about it is that the feedback cycles are extremely slow, right? So you make a VC investment and you don't know for years whether or not you're right. It doesn't matter. Like, all that stuff is easy to learn. The hard thing, the thing that I can't teach you, is judgment. But this ability to think very clearly, to question obvious assumptions, and to cut to the essence of something, I don't know how you train it. It has to be that you have experience making tough decisions. It can come from being a decision maker, building businesses. It can come from competitive computer games. I think can develop that ability to make decisions. If you've just been in school for your entire life, I don't think that trains you very well to make decisions. When you're in school, you're mostly being told what to do and performing tasks of memorization. You kind of have to build the reputation, the legend of yourself as an investor alongside it. And I said, look, I want us to be one of the most technical funds in crypto. When I'm competing with Olaf to win a deal, who does the founder pick? Do they pick me or do they pick Olaf? There's two quadrants at which you can look at any investment: consensus and non-consensus. Now, almost all the money in venture overwhelmingly gets made in non-consensus right.
Hi, and welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization in the blockchain revolution. I'm Brian Crane, and today I'm speaking with Haseeb Qureshi, who is the managing partner of Dragonfly, which is one of the best-known, largest crypto VC funds. So we're really excited to have Haseeb on today. So just before we go into it with Haseeb, we want to share a few words from our sponsors this week.
If you're looking to stake your crypto with confidence, look no further than Chorus One. More than 150,000 delegators, including institutions like BitGo, Pantera Capital, and Ledger, trust Chorus One with their assets. They support over 50 blockchains and are leaders in governance on networks like Cosmos, ensuring your stake is responsibly managed. Thanks to their advanced MEV research, you can also enjoy the highest staking rewards. You can stake directly from your preferred wallet, set up a white label node, restake your assets on EigenLayer or Symbiotic, or use their SDK for multi-chain staking in your app. Learn more at Chorus.one and start staking today.
Hey guys, I want to tell you about Gnosis, a collective of builders creating real tools for real people on the open internet. Gnosis has been around since 2015. In fact, it started as one of Ethereum's very first projects. And today it's grown into a whole ecosystem designed to make open finance actually work for everyday people. At the center of it all is Gnosis Chain. It's a low-cost, highly decentralized layer 1 that's compatible with Ethereum and secured by over 300,000 validators. So whether you're building a dApp, experimenting with DeFi, or working on autonomous agents, Gnosis Chain gives you a solid, neutral foundation to build on. But Gnosis is more than just infrastructure. It's also tools that people can actually use. Like Circles, for example, lets anyone issue their own digital currency through networks of trust, not banks. And then there's Metri. It's their smart contract wallet that makes it easy to access Circles, manage group currencies, and even spend anywhere Visa is accepted, thanks to their integration with Gnosis Pay. All this is governed by Gnosis DAO, where anyone can propose, vote, and help guide the network. And if you want to get involved, running a validator is super easy. All you need is one GNO and some basic hardware. To learn more and start building on the open internet, head to gnosis.io. Gnosis, building the open internet one block at a time.
Great. So thanks so much for coming on, Haseeb. I'm really excited. I was sort of diving a little bit into your story and your background. I think there's a lot of interesting things there. Maybe you can start there because you started sort of your first, real serious effort, it seems like, was in poker. Like when you think of today, what are the biggest things you've learned from that time that, kind of still shape you today?
Well, so I played poker professionally from when I was 16 years old till I turned 21. And, when I was 19, I was ranked one of the top online no-limit hold'em players in the world. Poker is a very unique game because there's nothing else that really teaches you how to think fluidly about risk and reward and about probabilities the way that poker does. It's in a way kind of surprising that we don't really have good ways to teach this to young people. Like I sort of still can't really even imagine if I don't have a kid, but if I did, I can't imagine how I would teach them how to think about risk the way that an investor does, other than poker. Like there's really just nothing like it when it comes to understanding the way in which you cannot be too risk averse and you cannot be too emotional about making decisions. And a poker table is one of the rawest places that will test your ability to actually make decisions under uncertainty and under, kind of emotional stress. So that part I think was really valuable training for what I would end up doing, much later in my career. As a poker player, I went through a lot of ups and downs, and actually, at the end of my poker career, there was this big blow up that happened. It was kind of a complicated story, but basically, there was this guy who was cheating, and he was one of my mentees. He was a student that I was working with, and my reputation ended up getting caught up in this thing because I was trying to defend him, and that led to me getting ousted from the poker community. And I was 21. I was very young. All of my, I dropped out of school to play poker. It was all that I was doing with my life, and it really caused me to really rethink what I wanted to do with my life and what, in a way, poker. It actually has a lot of similarities to crypto trading because poker is a very single player game. You obviously you're playing with multiple people at the table, but you're not on. There's no team poker. You play for yourself, and it's you against the world, and nobody really cares whether or not you do well. And so you're going through your ups and downs alone. There's a saying in poker that always resonated with me, which is that everybody who understands doesn't care, and everybody who cares doesn't understand. Meaning, in poker, you're always going through this volatility. You're always going through these swings of ups and downs because there's a lot of luck in poker in the short run. In the long run, it's a game of skill. In the short run, there's always ups and downs. And when you're going through those ups and downs, that's a lot of what makes it so psychologically challenging. And the people, you think about your friends, your family, your mother, they don't really understand what it means when you tell them, "Oh, I just lost 100K today." They're like, "Oh my God, is everything okay? Like, should we worry about you? Should we call someone?" And you're like, "No, that's not what I need. I just kind of need you to understand that, like, I'm going through a tough time, but like I'm going to be okay." And the people who really get it, who are other poker players, they don't care. They're just like, "Oh man, you're complaining. I'm like, I have my own problems. I'm going through my own downswing. I'm not a shoulder for you to cry on." And so you have to learn to be very emotionally and mentally resilient. I think it's very similar for a lot of traders. Is that if you're trading in crypto, you're on your own. Nobody's looking out for you. Nobody really cares if you lose money, and in some sense, like the only way they can make money is if you lose money. So that for me, it was really a cauldron. I think that forged a lot of my own determination and my own resilience. I think it was a very, very difficult time after I quit poker because I really didn't know what I wanted to do with my life, and I was really questioning myself as was I somebody who actually could do something valuable in the world? Poker is in a way, again, very similar to crypto trading. It's a kind of I don't want to say nihilistic, but it's a very selfish activity at the end of the day. Like I always reflected on the fact that as a poker player, it's a fascinating game. It has all this mathematical complexity and really beauty to it as a game. But in the raw reality of it, no matter how good I am, the reality is like, the way I make my money is some guy sits at a table who's a dentist or a doctor, who did something actually useful for someone in the world, and they come sit at a poker table and they lose money to me. And when you really think about it, like, okay, that's where I make my money from at the end of the day. I can glamorize it about the intellectual contest of this game of risk that I'm playing against other people, but the reality is like, yeah, I got really good at a card game, and that always really bothered me. And so it made me determined after I quit poker that I wanted to do something more valuable with my life, and that's what ended up leading me into the tech industry and eventually coming into crypto.
So yeah, I mean, I guess one of the really unique things about, because you mentioned the analogy to investing, and maybe with trading, it is a bit, you have to have fast feedback, right? But I guess
That's right.
The thing that's incredible about poker is just the immediacy and the amount of hands you can play and the amount of feedback you get. So I guess that's really hard to replicate anywhere else.
Yeah, trading is the most similar.
Trading, yeah.
Ironically, VC is actually quite different from poker. And it's one of the reasons why a lot of poker players find their way into trading. Very few poker players find their way into venture capital. Because venture capital, unlike trading, it's not a single player game, right? Venture capital is a multiplayer game at its essence, right? You're usually on a team and you win by helping people. You win by finding a founder, finding somebody who's building something and helping them to get there. And you only win if other people win, right? You cannot win in VC on your own, like obviously, by definition. So it's intrinsically pro-social in a way that both trading and poker are not. The other thing about it is that the feedback cycles are extremely slow, right? So you make a VC investment and you don't know for years whether or not you're right. And you get some signals early on. It's like, oh, this person raised more money, or they're getting some momentum. They got some Twitter followers. But being in crypto, that's no guarantor of success. And if anything, sometimes it's an anti-pattern if a project is getting all this hype really early. Kind of, sort of, it gasses out very quickly if it leans too much into just purely building hype. And so the reality is, it takes years before you actually get the full feedback loop, which means it requires a very different kind of thinking and a very different kind of mental adjustment than a game like poker or a game like trading, where you get instant feedback, right? If you enter into a trade, especially if you're a short-term trader, you know very quickly whether or not you made the right decision. And the same thing is true in poker, although there's uncertainty and there's some randomness, and that's also true in trading. But directionally, you're getting this reward signal that's pushing you in the right direction. In venture, it requires a lot more using a lot more fluid intelligence to understand, did I make the right call last week, last month, last year? And a lot of times the answer is that you really don't know. And people who look like they made great decisions in one vintage, in retrospect, it's like, actually, that was an absolutely terrible vintage. And the people who sat out from this particular trend, whether it's metaverse investing or whether it's NFT issuers or whatever, for a year or two, those people can look brilliant. And then 2-3 years later, all of a sudden, the evaluation of who did well and who did poorly completely changes. And that's happened in crypto so many times that it's really, in a way, quite fundamental to the way that VC works.
Yeah, I definitely want to get into that a lot more. I'm curious. So you said you had this phase of being kind of lost, and then you in the tech industry. I read. So you're also into effective altruism, right? So were these kind of connected?
They're very, very much connected. So when I was young, I made a lot of money at a young age as a poker player. I was surrounded by a lot of people who had made a lot of money very young. And the thing that I noticed pretty quickly, I think sooner than a lot of people get to learn this lesson, is that money doesn't make people happy. And if you're in the poker world, it's obvious, because you see all these people who are making all this money and they're miserable. And you realize, like, okay, I know all these people who are like, the classmates who I was going to uni with, who they don't have a lot of money, and most of them are actually pretty happy, even though they're scraping by. They don't have, they don't have a lot of cash, but they're having a great time. And people in poker world who are like sitting down hunched at a casino, they're staying up late, they're working odd hours, they're just they're miserable. Not all of them, obviously, but many of them, and that very quickly broke this connection in my head between money and happiness. And I realized pretty quickly that I was not somebody who's very motivated by money. I don't spend a lot of money. I don't really have a lot of need for flashy things. But I realized coming across the philosophy of effective altruism, this was around like 2012, 2013 that I first came into touch with these ideas. It incredibly strongly resonated with me that, okay, money might not matter very much to me, and I don't think money is going to make me happy. But money has tremendous power in the world, and that the effect of that money is very, very asymmetrical, right? That money can do a lot more good in a developing country than it's going to do for somebody like me who lives in America, and like, okay, well, I can have a nicer TV, I can have a nicer car, but it's not really going to change my quality of life in a substantial way. But a relatively small amount of money, just a few $1,000s, can be literally life-saving in another part of the world. And that was what ended up getting me on the train of thinking, hey, one thing I know that I'm good at is making money. I was able to do it very well as a poker player, and I bet I could do it again. And so if I go into a field that's lucrative and is something that I'm also driven towards and excited about and care about, like technology, I think I can donate a lot of that money and have a lot of impact, a lot more impact than I could just have on myself personally. And that was what made me decide that when I came into the tech industry, I was going to donate a third of my income to high impact charities. So I decided that in like 2013. And 2015 is when I first came into the tech industry. And ever since then, I've been donating a third of my pre-tax income. Now, the funny thing, of course, in crypto, you can't talk about effective altruism without talking about SBF. Because, of course, the most famous effective altruist in the world was SBF. And it's funny because I actually met SBF. The first time I met SBF was in 2014, before he was in crypto. He was still at Jane Street at that time. And I met him at an effective altruist summit in San Francisco. So he was, just a scrawny little trader, had the crazy hair, wearing the shorts. And I think I met him in a hallway at one point. I recognized him because he was somebody who was himself a very active donor in the effective altruism space. And I was an aspiring donor. I didn't have any money yet. So I was like, so I hope to someday have money, but right now I'm pretty broke. But I met him, and the next time that I would meet him would be many years later in Berkeley when he had started Alameda Research. So it's funny because effective altruism as a philosophy went through such, it's like crypto, right? It went through such a massive upswing in reputation and then absolutely cratered with the collapse of FTX. And it was very unfortunate that the industry ended up putting all their eggs, or not the industry, the movement ended up putting so many of their eggs into the basket of this one man. Because at the end of the day, there are a lot of people who are effective altruists. It's a movement that probably spans, 50, 60, maybe even 100,000 people. And most people are not that loud about it. They just kind of do it. They don't make their whole identity around it. Like I'm an effective altruist, been doing this for many years. I don't tweet about it all the time. I don't try to make a big dog and pony show when I make my donations at the end of the year. But the essence of effective altruism is really quite simple, which is just this idea that you think you're giving your money can have a lot more impact if you think about it in a more rigorous way. SBF was in many ways the worst element. It's like a good example of what happens when you take anything to an extreme, right? Any philosophy can be taken to an extreme. And at those extremes is when you start really untethering from kind of normal common sense morality, right? If you start being convinced that, hey, effective altruism is so important, I shouldn't take care of my friends and family, or I should give away everything that I own and kind of live as this weird ascetic, or I should steal people's money in an exchange in order to donate more to charity, right? Like when you start really getting off the deep end, you get into extremism, and there's religious extremists, there's philosophical extremists, and SPF sort of now serves as this cautionary tale to everybody in the effective altruism world of like, hey, everything should really be in moderation. That includes effective altruism. So anyway, I thought I would just give that thought. But I don't know if you want to dwell on the SPF effective altruism connection.
It's okay, I think.
Okay. Yeah. Fair enough.
Let's talk about crypto investing. So you got into that through Metastable, which probably not a lot of people know today, but it was one of the first crypto funds. Probably one of the first, certainly more like hedge fund like structure, if I remember correctly. What was it like working there, and what were sort of your biggest learnings from that?
So I came into Metastable, actually before I came to Metastable, I was working at Airbnb, came into crypto full time, worked at a company called 21, which became Earn.com. That's Balaji's startup. They got acquired by Coinbase. I left and then started my own startup. And that was when I ended up meeting Naval. So Naval, of course, the founder of AngelList, very well-known angel investor, sort of influencer, life guru, Silicon Valley. And he ended up convincing me to shelved my startup and joined Metastable as a GP. So Metastable was one of the very first funds in crypto. I didn't know anything about investing at the time that Naval recruited me. Like literally my own portfolio I just had in, index funds. I don't think I'd ever made really a serious stock investment. Like even stock picking is something I just didn't do. I was just like, no, just index invest. I've read all these papers that, nobody can beat the market. So just do passive investing. And Naval was like, hey, you should become a VC. And I was like, I'm a VC. I don't know anything at all about, finance. I don't know what a term sheet is. I don't know what carry is. I literally didn't know anything. And Naval was like, look, it doesn't matter. Like all that stuff is easy to learn. The hard thing, the thing that I can't teach you is judgment. But if you have judgment, the rest of it is, you're a smart guy. It's pretty mechanical. I can teach you the rest in just a few months. That, in the beginning, when I first came into Metastable, I really thought this is going to be temporary. I'm going to come into Metastable. I'm going to kind of hang out, learn a few things. But then, of course, I'm going to go back in the startup world. I'm going to go build something because I saw myself as a builder, but also, psychologically, I just thought like, well, building is obviously the real thing. VC is like this kind of, whatever, sort of, bullshit job that you do in the interim of like early retirement or something. It's like a waiting room before you have a good idea. And over time, I came to appreciate more and more that venture was actually something very, very interesting and unique in its own right compared to what I was doing before. And the way that Naval described it is something that still resonates with me, which is, if you're building a startup, you imagine crypto is like this wave that's coming to shore, and we know the wave is going to hit and it's going to transform the beach. And if you're a startup, you are like one grain of sand in that wave, trying to make your way to shore. And you might make it, you might not, and like it's you against the world. And it's like, okay, this is the titanic conflict that every startup founder feels like they're in. But to be an investor is to pull up a chair at the side of the beach and to take bets on which grains of sand are going to make it to shore. And in a way, okay, maybe there's some element of diversification you get as an investor, but the more important thing is that it's actually really the best seat in the house to watch the wave come in. Because there's no better place that you're going to really get to see what actually happens to the world. And to be able to test your intellectual ability to predict how it's going to play out. I came into crypto in 2017 full time. And at that time, people were talking about the ICO boom and, the way in which, IoT was going to get transformed and all, it's funny because one of the very first podcasts I was listening to was actually this one, Epicenter, because there wasn't a lot of technical content back in 2017. And, listening to the show, I was very studiously would listen and, try to understand like, what does IOTA do? What does Foam do? All these projects from that era, you dutifully listen and understand and really try to predict, is this the future or is this a mirage, right? Is this wave going to make it shore? As an investor, that's fundamentally your job, right? And there's a lot of other stuff that goes into it about sourcing and building relationships with founders and helping them out. But this is the core of what investors do. And to be better at that, at being better able to predict where the future is going and how technology will evolve, I've come to appreciate is the most interesting thing to me of anything that I can do. Building is fun. It's very satisfying to feel, your thing turning into a real product out in the world that people use. And in a way, building an investment firm is similar in many ways. Having built Dragonfly, we're like 45 people around the world. We're a big brand. We do a lot of things that any company has to do in order to establish itself and to build a strong reputation. But at the end of the day, investing is really about predicting the future. And to me, there's nothing that quite resonates as much with me anymore as getting to do that for a living.
So you mentioned the judgment thing as this, crucial thing an investor has to be good in. Do you think this is something you just had? Did you learn it in some way? Is it something that do you try to develop it, and like how?
I don't have a good answer to that. Like, honestly, when I look, because we obviously hire a lot of investors and we interview a lot of investors, and I'm now on the reverse side of the table. I'm where Naval once was when he was looking at me, and how to determine, does this person have judgment, right? Obviously, when people come in and they're junior, they don't know that much about investing. They don't know that much about VC. We'll often ask them a case study of like, hey, would you make this investment? Write me a memo about why you would or wouldn't make this investment. And you read this memo, and some of them are very polished. You can tell, okay, they've thought a lot about investing before. Some of them are very unpolished. But most of the time, you can really kind of see through to, does this person have that spark of insight that they can think for themselves? They can think very clearly. They can cut through to the center of the problem. And it's sort of like, do you get there in one cut, or do you slowly kind of trim around the edges and maybe eventually you'll get there? And that question, when you see it, you know it instantly that, okay, this person has good judgment. And it's not always connected to the fact that they've been an investor before. A lot of people who are very good at this and can think very clearly and lucidly about making good investment decisions don't have training as professional investors. But this ability to think very clearly, to question obvious assumptions, and to like cut to the essence of something, I don't know where it comes from. I don't know how you train it. It has to be, like almost certainly, when I think about it, it has to be that you have experience making tough decisions. And where would you get that kind of experience? I think it can come from many different places. It can come from being a decision maker, building businesses. It can come from games. I think games are one of these places that do actually, if you're competing at a high level in games. I think it can even be true for not things like poker, but even just competitive competitive computer games. I think can develop that ability to make decisions repeatedly very well. But most people who are, if you've just been in school for your entire life, I don't think that trains you very well to make decisions. I don't think you're making a lot of decisions when you're in school. I think when you're in school, you're mostly being told what to do and performing tasks of memorization and, largely conformity, which is, can you go home and like do the thing I asked you to every single night and memorize this stuff? But the reality is that, being able to memorize things is totally useless in investing. There's nothing you need to memorize in investing. On some level, you need to have just general background knowledge about the world and about, okay, I need to think about how big of a problem is this that's worth addressing. But very little memorization is involved. Very little of what you learn in school is going to be applicable to something like investing in crypto. It's mostly your ability to teach yourself, to think fluidly about new domains, to really be able to, again, make difficult decisions that nobody else is going to explain to you how to make. The more that you've done that, the better you're going to be at this. And that's one thing that I think for poker, it's not just that when I was playing poker, I was making tough decisions at a poker table. It was also that the era in which I started playing poker, and to be clear, I think poker is actually very different today than it was at the time that I was playing it. Poker was not very developed as a game when I first came into playing poker, meaning that today you have these game theory optimal strategies that are very well worked out. People do studying alongside these solvers, which are these programs that will basically output the game theoretic optimal Nash equilibrium for a given poker situation. And mostly what people are doing is they're studying what the computer is telling them. The computer knows the answer. It's like chess, right? Poker has become much more like chess in the last 10 years. Poker was not at all like that when I came into the game. Poker was still in the process of being developed as a fully fledged game. And as a result, a lot of what we were doing, like what I see us, like me and my peers in that generation, was much more like science. It was much more us trying new things, developing different parts of the poker meta, and really challenging a lot of the assumptions of the poker players who came before us. Right? It was actually, like, when I look back of what I loved the most about poker, it was that. It was us kind of opening these new frontiers and experimenting with new strategies that nobody had really tried before and proving that they could work in different ways. That skill, most people don't have. If you went to school, you've never done anything like that in your life, unless you are at a postgraduate level, you're a researcher or something like this. That skill is the skill that I think most translates into being able to be a good investor. Because being able to be a good investor means, okay, the year is 2021, play to earn was just invented. What the fuck is play to earn? How does it work? Where's it going to end up? Right? There's no book you can read. There's no expert that you can consult. There's no amount of learning you've done in your life that would prepare you to answer that question. You have to think for yourself from first principles where you think it's going to go, and you have to make a bet on it.
Yeah, yeah. Do you think your ability, this kind of judgment, is developing much today? In what way is it evolving?
It's a good question. I think um, I would say that my ability to make decisions within investing is getting better. As I get more data, as I have more experiences, as I make more mistakes, I'm learning, and as I have more successes, I'm learning from all of these things, patterns and behaviors that I'm realizing are more and more important, right? So just to give you one example, right now, I have a portfolio company that's going through a co-founder breakup. So two people started a company together. They were very good friends. Now they're splitting apart. They hate each other, um, and navigating a co-founder breakup is one of these things that the first time you do it as a VC, you just have no idea what you're doing. It's like a divorce, and you're like the friend of both of them, and you have to somehow safeguard, what's going to happen to the kids and what's going to happen to the all the stuff. But also, okay, these two people who I also care about, and I want to make sure that they're going to do okay. It's better for everyone if they do okay. You have to navigate that. And it's almost like being a mediator, but then also being an investor and also being, you do a lot of different things at the same time. First time I did it, no idea what it was, it was just totally unprepared to deal with that. Now I've done it many times. And the nth time you do it, the better, more solid, more capable, more fluid you become at being able to help people navigate those difficult things in a startup. Same thing with dealing with M&A, or dealing with some kind of strategic pivot, or helping a company figuring out its hiring strategy. The first time you do it, you sort of stumble along. When I was at Metastable, the funny thing about Metastable is because Naval, he's such a well-known person. He was so famous. Obviously still is, but at that time he was very, very active in the crypto investing market. Everybody wanted his money. And so when I was at Metastable, even by the time that I left, I had never actually won a deal. When we wanted to make an investment, it's always like, okay, so at Metastable we did the seed round of Avalanche. And I was like, hey, I think we should do this. I think Goon is great. Let's do the seed round. I knew Goon and I had a relationship with him, but at the end of the day, he didn't want my money. He wanted Naval's money. And so Naval was the one who went out to say, okay, Naval, we want this much allocation. He would go and he would go win the deal. And it was at Dragonfly that I had my first ever actually, okay, Haseeb, it's your job to win the deal. You have to convince the founder to take your money. And why would you take my money over A16Z's and Z's money or Paradigm's money or Polychain's money or anybody else's money? And it's intrinsically like a very, you sort of have to be, this goes against a lot of your instincts. If you're somebody like me, to say like, hey, I'm amazing. You should work with me because I'm a special guy. And like, I'm exactly the person you should work with over everybody else. Everybody else sucks. And I'm the one who's going to, solve all your problems. You have to do that. You have to sell. You have to fundamentally convince the founder that you are special compared to everybody else, and you will solve their problems in a unique way that nobody else will. And that skill is a skill that you can only get better at through practice. So the judgment thing itself, I think at the end of the day, I don't actually know that my judgment, at a core level has really gotten that much better over the time that I've been at Dragonfly. I think my judgment as an investor has gotten better in the same way, as a poker player, I got better and better over the years at playing poker. But would my judgment translate? I don't know. I think that the one thing that I have noticed in myself since I became a VC, so, I before this, I was a software engineer, I was a builder, I was, of course, a poker player. I only ever played, again, largely single player games. So, when you're a poker player, you're playing for yourself. You don't really need to be a social butterfly to play poker. And of course, being if you're a software engineer, it's like the most quintessentially antisocial job is writing code. But VC is hypersocial. All you do all day is talk to people. And when I first started, it was just exhausting for me. It was very, very difficult because I was psychologically and mentally quintessentially a builder. And now that has really changed kind of who I am. And it's something that all my friends and my family, they can't help but notice, is the way in which becoming a VC really changed me. And I think in that respect is very good for me, because when I first started, I could not handle a day full of meetings. Like literally, I would collapse at the end of the day. I'd be like, I have to cancel. I cannot do another meeting. Like I'm so exhausted talking to people. I just want to like read, and go read a white paper. Like that just sounds so nice to me compared to having another fucking meeting. But leading a firm, building a team, and on some level, part of what you have to do as a VC is to build your own brand very intentionally, because at the end of the day, VC is a people business. On some level, yeah, okay, Dragonfly is a brand and people care about Dragonfly now, and okay, it's kind of cool if Dragonfly is your lead. But at the end of the day, funds don't really have independent brands of the people, right? Like if I bounce from Dragonfly and like everybody leaves and we turn over and there's a new team at Dragonfly, it's not like Airbnb. If Brian Chesky leaves Airbnb, nobody really cares. You'll still use the product. Like I don't think anybody would even be like, oh, I don't know if I can use Airbnb anymore now that the CEO has changed. But at a VC fund, it kind of is, right? The VC fund doesn't really mean anything without the people there. And so at the end of the day, like you kind of have to build the reputation and the legend of yourself as an investor alongside it. And that was something that would have been very difficult for me 4 or 5 years ago. And it's something I've gotten a lot better at.
So when you started Dragonfly, what was the kind of company you wanted to build, and how did you want it to be different from the other crypto funds?
So that was actually very central to my decision to join Dragonfly. So I joined Dragonfly about like 6 months after they first started. So I wasn't there at the very, very beginning. The fund it was like half raised at the time that I joined Dragonfly. So I just left Metastable, and I was kind of a free agent deciding what I wanted to do. And funny enough, I was actually working on a course. So back when Balaji, after he left Coinbase, he started this thing called Nakamoto, which was this like publishing thing. I don't know if you remember this, but I created this course like of blockchain 101, and I was working on this, and I thought I was going to write a book teaching blockchain. So long ago, and in a way, this is also when the educational materials in crypto were much worse than they are today. So thankfully that gap has largely been made up. But at that time, there was really only podcasts and one textbook, which was the Princeton textbook. Which that's how I learned about crypto, was reading the Princeton textbook. And so that's what I was doing at the time. And Bo ended up approaching me and trying to convince me to join Dragonfly. And Dragonfly at the time, they didn't really have much of a brand. I don't think anybody knew them in the West. They were kind of this. They'd invested in other funds. They'd invested into Polychain and Paradigm and a bunch of other funds, and they did some deals like kind of follow-on investments alongside some of their other managers that they were backing, but they weren't really doing direct deals, right? Investing directly into companies, and they weren't leading any deals. And so, Bo pitched me on this vision of building a global fund. And when I say global fund, at that time I had never actually been to East Asia. Never been to Japan, never been to China, never been to Korea, never been to Singapore. This was back in like 2017, 2018. And I knew that crypto was big in Asia, but I kind of knew it intellectually. I was sort of like, well, now that I know this, I can make decisions on that basis, but I don't really need to go there. And like, I don't need to meet a miner. I know mining exists, but what does it really matter? The details of what they do. And Bo was the one who convinced me that no. If you want to understand what's really happening in crypto, if you want to understand like this global phenomenon, you have to be able to see the whole elephant, right? Like if you haven't seen it with your own eyes, you don't really get it. And all the VCs in crypto at that time were almost to the last man based in Silicon Valley. Certainly in 2018, before COVID, everything was in Silicon Valley. And it was out of Silicon Valley that people were investing in this thing that's happening all around the world, right? And I was very much that. I was, at Metastable, we were in San Francisco. We never invested in anything that didn't come to SF to meet us. And Bo's vision was very different, and it really resonated with me. They're like, hey, actually, why is no one doing it this way? Why is nobody opening the aperture and looking at the whole totality of what's happening in crypto globally? And what would it look like to build a firm with that being the initial animating hypothesis, that actually if you could see the whole thing, you would do it somewhat differently. That was the pitch that he made to me. And I told him, like, look, I'm potentially down to join, but I have some demands. And if you can meet those demands, then I'll join. The first demand is that, at the time, Dragonfly was not a technical team. There was nobody technical on the team. And I said, look, I want us to be one of the most technical funds in crypto. That's what Metastable was. Metastable was led by Lucas Ryan, who was, he studied cryptography at Stanford under Dembélé. And the way that he taught me how to invest and how to diligence stuff was, you go into the GitHub, like you actually understand from a protocol level what they're doing, what the attack surface is, how robust is this technology. Like if you can't run it yourself, you don't understand it. And that kind of technical approach to diligence, like really nobody in crypto VC was doing at that time. This is before A16Z crypto, before Paradigm. Most of these teams were run by people who weren't technical in the VC world. And so that was the first thing, is that I want us to build a technical team. I want us to be known for being technical. Second is that we got to start leading deals. I want us to be actually competing with the polychains of the world, with the Panteras, with the A16Zs. And third is we're no longer going to invest in funds. Everything that we do from now on is going to be direct. We're going to work directly with founders, and we're going to be known as being one of the premier funds in crypto. And Bo said, I'm down. And that was how I ended up coming into Dragonfly. So that was the original thesis of the kind of firm we wanted to build. And now at the time we didn't have a lot of resources, and again, we were flanked by the polychains and the Panteras and the A16Zs, who were much bigger, much better resourced. I mean, at that time, those guys were huge. My goal originally when we first started Dragonfly was to someday beat polychain. Now, today that might seem really bizarre, of like, well, polychain, why polychain in particular? It's like, no, you don't understand. Polychain at that time, they were the number one fund. They were the only people who had $1 billion of AUM. They had backed almost everything from the first generation of crypto. Whether it's MakerDAO, Polkadot, they were in Avalanche. There were so many things. Cosmos early. They had so many wins. And looking at polychain, I was like, someday, we're not there yet. It took a long time for us to climb that mountain, but someday we're going to beat polychain. And
so polychain in terms of getting into deals, or in terms of
exactly. Yeah. As a VC, the way that you think about like what's the actual head-to-head is when I'm competing with Olaf to win a deal, who does the founder pick? Do they pick me or do they pick Olaf? Right? At the end of the day, that's the head-to-head. It's kind of like in poker, we call it playing heads up, which is one-on-one. Like if you want to ask like who's the better player, which fund is winning, the answer on some level, it's like, okay, did you make better investment decisions? Obviously that matters, but it's hard to quantify that. It's hard to tell because like I said, all this stuff takes years to play out. But the one thing that you can know as a platform, as a brand, is my fund winning? At the end of the day, the number one determinant of who ends up getting the better returns is who can get the better deal, who can win. And the way that there's one way to think about investing is that there's two quadrants at which you can look at any investment. Okay, those two quadrants are consensus and non-consensus, meaning that everyone agrees this guy's going to be the winner, or maybe you see something other people don't. Right. So an example of a consensus deal would be something like take OpenSea. Right. So the OpenSea Series A was an incredibly competitive round. Right. This was like in I don't know, what was this, like early 2021. OpenSea was growing like crazy. Everybody knew that OpenSea was going to be the winner. And everybody was competing to try to win that deal. Everyone gave them a term sheet, every single VC you've heard of. Or take, for example, the Mega ETH Series A. Incredibly competitive round. Everybody was giving term sheets to Mega ETH at that time. And this is a consensus deal. Now, there's non-consensus deals as well. So a non-consensus deal would be like the Solana seed round, right? Solana seed round was not competitive. Right, Solana pitched everybody. Multicoin won it, but they didn't like win it because everybody, they beat all these other people. They won it because everyone else said no, and so okay, Multicoin won it. Same thing with the Solana Series A. They pitched everyone. Everyone said no except for Multicoin. And so you have these consensus deals, non-consensus deals, and there's consensus right and consensus wrong. Right, so there are times when everybody has consensus on a deal, and the deal is correct. Right, it is the winner. Everyone knows it's going to be the winner. And then there are times when the consensus is wrong. Now, almost all the money in venture overwhelmingly gets made in non-consensus right. That's where you get the 100x's, the 150x's, the 500x's, right? And everybody knows venture's a power law business, and that means that the really, really big outcomes are the ones where you make the lion's share of the returns. But a lot of money also gets made in consensus right. And there's consensus wrong where you're going to lose money, and then non-consensus wrong. That's where you're making crazy bets out there that don't pay off. So non-consensus right is where your brand doesn't matter. You don't need to have a great brand in order to do non-consensus right deals, right? And in a way, if you think about early one confirmation or early multicoin, they didn't have the best brand in crypto, but they were able to win these non-consensus deals, and they eventually able to parlay that into building a great brand. But consensus right deals are consistent moneymakers, right? That's where a lot of the money in venture gets made. It's not where the really incredible outcomes generally happen, but it's places where you'll consistently make good money. And that is purely a game of brand. If it's consensus right, everybody knows. The classic examples of Google Series A. Everybody knew Google was going to win, but only Sequoia got to play, right? Because Sequoia is Sequoia. They had the brand to be able to win that deal. So that's where brand matters. And that's why it's very important to cultivate that ability to win head-to-head against another VC. If you look at our biggest wins, one example of this is the Athena seed round. So we led the Athena seed round. That was non-consensus. Now, why do I say it's non-consensus? One, it wasn't a super competitive round. Second, it was after Terra collapsed. Right? So we led the Athena seed round after Terra collapsed, after people thought DeFi was uninvestable, and especially people thought that an algorithmic stablecoin was completely uninvestable after the collapse of Terra. And so it was our ability to identify that, hey, no. What's happening with Athena is different from Terra, right? We never invested in Terra. We passed every single round of Terra because we understood that the mechanics of Terra were fundamentally insecure. They're fundamentally something that, as it went to scale, it was going to break with probability 1. But something like Athena, no, Athena is a cash and carry trade. Cash and carry trades have been around forever. This is the oldest thing in history. Like I was talking to hedge funds that were pitching the cash and carry trade back when Dragonfly first started. It's a very well understood financial product. It's not like, oh, this is a bank that takes on more and more leverage the bigger it gets, right? That's what Terra fundamentally was. So understanding that and being able to see through to the future is how a lot of the returns in venture get made. But the measurement of winning is how most of the bread and butter of venture works. And so that was when I say that I wanted to beat Polychain, that's what I mean. Eventually you beat them in returns, but the first thing you see as you become a better fund is eclipsing them in terms of being able to win in the head-to-head.
But you still think like most of the returns, if you think of like Dragonfly's track record, was more in this non-consensus right bucket, or like to what extent was the consensus right also a driver for this?
It's usually something like 70-30. Is that 70% of your returns come from a very small number of non-consensus deals. And then 30% of your returns, which is still substantial, comes from your consensus deals. And most of the time, it's not always true, right? So it's not literally true that Athena had no other bids when we won that deal. But it was not the juggernaut. It was not perceived as the juggernaut that it is today, right? It wasn't every single VC, every single neighborhood VC bidding on that deal. But there are a lot of times that like the big winner can end up continuing to win and win and win and win and win. One example of that is something like Hyperliquid, right? So we were one of the VCs that was trying to get Jeff to take a VC check. And we were, this is relatively early before their airdrop, obviously. We'd built a relationship with him and we were really trying to win that deal. And we weren't winning it against other VCs. Like there was no round. It was us preempting and trying to get him to take our check because we thought what he was building was really different and really compelling. And ultimately, he got close, but he said no, that I don't want to take any VC money. And, there were other firms, other top tier firms that were trying to do the same thing later, of trying to stuff him with a term sheet, trying to give him a bunch of cash and say, hey, let's do something even though you're not looking for money. Your ability to do that is ultimately constrained by how strong your brand is. But at the end of the day, you're never going to win all of them, no matter how good your brand is, right? There's always some hyperliquids out there that will just say no to everyone. And no matter how good your brand is, even if you're, A60 Crypto or Paradigm or Sequoia or whoever, you're always going to lose deals. And so the question is, as a fund, do you have that feedback loop of, okay, we lost this deal. Why did we lose the deal? Do we actually understand why we lost? And is this a problem that we can learn from and get better at So the next time we go at this, we're going to do better, right? If you have that mindset, like a product founder, that you're constantly thinking about how to iterate in the direction of getting better, then with near certainty you will improve as a firm. The weird thing in venture is that one thing I realized, part of the reason why we've been so successful in venture, well, I think a few reasons. One is that we're just really persistent, and a lot of people just kind of gave up when crypto went through downturns or when things went badly. They just didn't have the resilience to keep going. That's honestly the most common thing that I've seen from all the VCs that I remember from when I first came in the industry. Most of them aren't here anymore. Most of them just bailed. So that is the most obvious thing, is just, do you have the stomach to be able to handle an industry that's as chaotic and as cyclical as crypto? But the second thing is, like, why did you get into venture? A lot of people came into venture because they think that venture is this genteel job that you can just do on in the summers, and you take the summers off and you work like 9 to 5, and then it's like ultimately a kind of early retirement for people. Like, that's how they see it. They see it as this like high status job that you get invited to a lot of cocktail parties and you get to pontificate on Twitter. And that's not how I see it. Like, that's not why I got in the space. I came in the space to win. And I come in the space to win, and to me that means that every single day you're getting better. Every time you lose a deal, you obsess over why you lost. Every time you don't see a deal, you try to go understand, why didn't I see this? Why didn't this founder come and talk to me? And if you don't have that mindset, like, you're just going to lose. You're just going to keep losing and losing and losing, and not learning why you're losing. And so that feedback loop, that iteration cycle that founders have of getting better every single time, every single day, every single moment you get product feedback. How can we get better? How can we get better? How can we get better? That loop, I learned with enough time that a lot of VCs don't do it. And they just keep sucking as VCs and not ever really committing themselves to intentionally getting better. And that's why, as a firm, I've been continually surprised at how quickly we've lapped so many other VCs have been doing this much longer than us.
So you mentioned the ability to get into deals. Obviously, there is ultimate returns of the fund. Are there other sort of dimensions by which you judge the success of Dragonfly?
I mean, there's ultimately 3 dimensions that you care about as success as a firm. So the first and foremost is returns. Returns at the end of the day is the North Star. The second is brand, right? Your ability to actually win deals when you're up and head to head against another firm. The third is ability to raise money, because at the end of the day, VC is a scale business. So if you cannot actually raise the capital you need to go deploy your strategy, then it doesn't really matter how good you are, right? Because you don't have the money to actually go put all this stuff into motion. So you learn as a VC is that you kind of have 2 different audiences. One audience is the founders and just kind of the crypto community, how they perceive you and how they understand what you're doing, and how they perceive your brand. The second is actually among LPs, which are a totally different world. They don't read crypto Twitter. They don't care, how many retweets your stuff has gotten. To them, your brand is constructed by this totally different channel and style of communication, which is to institutional investors or to family offices or whoever it is that you're raising your capital from. How do they perceive you? What content do you create for them? What are the things that you've done in this world that contribute to your brand? And they care a lot more about things that nobody in crypto Twitter cares about.
When I was reading through your blog, one of the things you linked to was this post by Mark Andreessen, where he talks about, people, product, and market as sort of, 3 dimensions by which you can evaluate a startup. And, he comes like, hey, the most important is market, right? If you don't choose the right market, like, the rest kind of doesn't matter. I'm curious, like, if you, let's say you left being a VC and you had to start a company in crypto, what would be, I don't know, 1 or 2, maybe 3 markets that you would focus on?
That's a great question. I definitely can't name you 3. I think so. Probably if I were to try to build something, I would be spending a lot of time at the intersection of crypto and AI. I think probably the thing that I would want to build is to work on AI-powered wallet automation. I think this is the
AI-powered?
kind of wallet automation.
Okay.
So, how can I get my wallet to be much more intelligent than it is today? And the reality is, like, we depend a lot, like our security model and our UX model for wallets is very, very highly dependent on humans catching mistakes. Whether it's mistakes in, oh, is this the wrong contract? Am I getting spearphished? Or, like clicking through all these buttons to bridge from here to there. And it's like, oh, make sure you come back in 3 minutes to, like, do this other transaction. And clearly, the wallets should be a lot smarter than they are. They should be able to do a lot more of this, such as a human being, you're operating at a higher level of autonomy and direction giving compared to where the wallets are today, which are extremely brittle. And there's almost no intelligence that's baked into your wallet besides a little bit of transaction simulation these days. I think that is going to be one of the most titanic changes that we see in the crypto industry over the next few years because of AI. And I think in order to get there, you need to do reinforcement learning at scale with a really robust data pipeline and simulation environment in order to do that. And I haven't seen anyone really try to tackle this today. I think it actually requires quite a lot of capital. And I think it's a very hard problem to solve. And we're clearly not there yet. Like we were not even capable of solving it today because, models cannot consistently order pizza. They can't even consistently book a flight. What makes you think they can consistently, bridge assets and do DEX trades and like not get phished, right? Like that's even harder than ordering a pizza. So, if you look at the latest generation of models, I think if you look at, the newest Claude 4 Opus, some of these agentic benchmarks, I think on ordering a pizza, it's something like 80% ability to order pizza and like 60% on booking flights, which is, it's incredible compared to where they were a few years ago. But it's still abysmal in absolute terms, right? Like if you had a personal assistant who could order you a pizza 80% of the time, you'd be like, what the fuck is wrong? Like, I'll just order all my own pizzas. Like I'm not even going to deal with this. But I think they will get there very soon. I would guess within a couple of years, we're going to have these things consistently booking flights for us. And the whoever wins this of being able to get AI and getting agents to work directly within your wallet and be as trustworthy as a self-driving car, right? If you think about, I don't know if you've ever taken a Waymo, but today, you take a Waymo in San Francisco or in Phoenix or in Austin, and it's just like I trust this more than I would trust an Uber. It's kind of it's slower and it's more methodical today, but it's almost certainly safer than going in an Uber. So when are we gonna have self-driving wallets? And those self-driving wallets are going to totally change our experience of blockchains. I think this will be one of the biggest companies and one of the biggest opportunities because of the fact that it's going to change our relationship with blockchains, right? Not just that, okay, I will be able to tell my wallet, hey, move my assets from here to there. It's that I won't even care where my assets are. Because why would I need to care? I'll just tell, like, hey, I want to go trade on Hyperliquid. Go get me a 5x long on Bitcoin. And the wallet will just figure it out. It'll say, oh, well, my assets over here. I'm going to go bridge. I'm going to go do this. I'm going to do that. Da, da, da. It's just going to happen in the background. Same way, I tell my Alexa, hey, order me diapers, and it just does it. Right? I don't need to deal with anything. That will happen. You will trust the intelligence of your wallet enough to be able to delegate that task to it. And when that happens, how does that change your relationship with blockchains? How does it change your relationship with Arbitrum, with Solana, with all these things? When I no longer care what chain this thing is on, I no longer have even allegiance to say, oh, well, I'll only use Solana apps because, I love Solana. I'm a Solana guy, right? That, I think, is going to be the biggest shift that we see in crypto over the next 5 years. And that, I think, that's the kind of scale of opportunity that if I was going to build something, I would want to go after.
Yeah, I totally agree with you. I mean, I think one aspect of this that to me seems so crazy and illustrates like how crucial this is. It's just like wallet security, right? Because it's so hard, and it feels like it's actually gotten worse. I mean, at least back in the day, everyone was like, oh, not your keys, not your coins, self-custody, it's the way to go, right? And it was very much, and like, you onboard people onto crypto and they're like, you have to write down receipt phrase your own wallet. I think today, with like, you can often barely predict what are you signing. You have all of this phishing attacks, hacks, sophistication. It feels like something where most people shouldn't actually use a wallet, right? You shouldn't do self-custody. And I think the only thing that can solve that would be something like this, where you can basically say, oh, I want to do this, and then there's some verification thing that translates into a transaction, verifies that this is really the right thing, what you want to do. So yeah, I think
at some
this
level,
is a massive
like
one.
if you look at smart contracts, right, in a way, smart contracts, we talk about how magical they are and how amazing they are, but the thing that's obvious about them is that they're really not designed for humans, right? In a way, they're kind of designed for machines. Like it's a lot easier for a machine to parse EVM bytecode than it is for a human being to do so, right? And it's certainly easier for them to parse Solidity with like a, if you've got this, diamond contract thing with like, you can't even, you look at the code, you can't even tell what the hell's going on. Even if you can read code, you can't tell what's happening. But an AI can very easily go and parse the contract that it's interacting with, simulate it, interact with it, go see what are other deployed instances of this contract. Are there any wallets that have been poisoned by it? Check the DNS records, make sure nothing's changed recently. Like all this stuff, there's nothing stopping you from doing it. You could do, if you were sophisticated enough, you could do it, but you just won't, right? You're lazy, it's slow, it's time consuming, like you just don't have that level of patience. But an AI never gets bored, never gets lazy. It's like a Waymo. A Waymo never does a rolling stop. It's kind of annoying that it never does a rolling stop, but it never does a rolling stop because it never gets impatient, right? It's just like, okay, here's a stop sign. I will come to a complete stop and then I will start again. And, it's like maybe we need to modify this behavior, but at the end of the day, it's completely configurable by us. The level of scrutiny and carefulness that these AIs will take. Now, there will definitely be attacks against AIs, and that will freak people out when the first time, an AI does something purely that a mistake only an AI would make and that a human being would never make. But eventually we will get to a point that AIs are safer than humans for self-custody. And eventually, and I think it won't take too long to get there, that AIs will basically never make a mistake of that kind, right? Just because of the fact that it's actually pretty easy to understand, hey, the user wants to trade on Uniswap. The user wants to use this app. The user wants to do this. The user wants to do that. And almost every case, not every single one, but almost every case, if a technical, intelligent person had reviewed this attack surface area, they could have figured out something went wrong. But just nobody is ever doing all those checks all at the same time, right? One of the things I think that is to be proud of is the industry, even though I agree with you that wallet security is really difficult, it's really fraught, is that if you look at the amount of hacks that have taken place in crypto over the last 5 years, the amount of hacks actually at the smart contract layer have plummeted. Almost none of the losses that you see anymore happening on chain are actually smart contracts getting hacked. It's almost always spear phishing, wallet compromise, some kind of malware, user error. And the reason why is that we've actually figured out how to write secure code now, which is thank God, right? But like if you even think about the Bybit hack, which of course unfortunately happened relatively recently, one of the biggest hacks in crypto history. Full disclosure, we're investors in Bybit. That hack, the question is like, okay, well that wasn't even Gnosis, like the smart contract itself was not compromised. It was the front end that was compromised. And if they had checked the actual hash corresponded to a clean computer computing the hash of what they thought they were citing, they could have noted the non-correspondence between those two, right? And again, an AI could have done that. An AI could have went and spun up a virtual machine and go and verified that thing, or ran the code itself. But they didn't do it, and maybe they would have if they had infinite time, but they didn't. An AI could have also just read the front end. If you'd read the front end, you would have seen that there was a special case in the JavaScript on the front end that said, if your wallet is this, do this instead, right? That code was there in the JavaScript payload that they were served. And as a human being, you're never going to see that. You're never going to check. But an AI will always check. An AI will always check. So that is my fundamental intuition where that comes from, of why wallet security in 5 years will be much better than it is today.
Let's talk a little bit about the market. So right now, the market is in a kind of interesting position, right? Bitcoin is obviously doing extremely well. And at the same time, a lot of the rest of crypto is actually struggling a lot. I mean, I think sort of the entire altcoin market, a lot of the new tokens that are launching, of course, funded by VCs, and where like VCs mostly invest, right, have basically struggled to find any buyers, with some exceptions. What are your thoughts on where the crypto market is today?
Well, there's definitely malaise in the altcoin market, and you can see that there's not a lot of retail activity in alts. Um, that being said, I think in absolute terms, crypto market is doing okay, right? If you look at where is that marginal retail buyer instead, the answer is that they're in public markets. So you can see, with the Circle IPO, you can see with all these, MicroStrategy and with all these treasury plays that are coming to public markets, that's where you're seeing a lot of the energy and attention really being driven. Now, crypto markets are very cyclical. And we know that right now we're in a cyclical lull. Most of the attention is on Bitcoin. Monetary policy is still quite tight, right? If you remember back in the beginning of last year, we thought there would be 6 rate cuts last year. Instead, we got 2. This year, we've had none. And it's already halfway through the year, right? And again, we thought there were going to be more rate cuts this year. So we're continually being disappointed on macro, and altcoins are by their nature very sensitive to interest rates because interest rates are basically just the cost of risk. They're when interest rates go down, that means that risk appetite is higher almost by definition because people are being paid less to take less risk. So when people are being paid very little to be safe, they're more inclined to go further on the risk curve. And altcoins are pretty much the riskiest of the risky things that are out there. So altcoins are by their nature going to be very sensitive to macro. And I think you should expect that to continue, is that the institutional bid that's arisen for Bitcoin is relatively unique, right? Because that has come about for reasons that have nothing to do with the overall broad crypto cycles that we otherwise see. But if you think about where crypto was relative to the beginning of this year, beginning of this year, altcoins are probably 2x where they are now. Like, Solana was roughly 2x where it is. Most altcoins are probably roughly 2x below where they were, or 50% below where they were at that time. I think you will eventually see a reversion, but it's going to have to be macro that leads first. In absolute terms, it's very obvious that the positioning of the US government, which has been the most powerful government in the world, waging war on crypto over the course of the last year, the fact that that's completely reversed. And now we have the most positive and constructive government we've ever seen in the US about digital assets, or almost about any tech industry. That obviously should mean that alts are worth more than they were 6 months ago. Or like if you just think even before Trump was elected, alts were higher than they are now. So I think what's happening right now in the alt market is an anomaly. I think it will eventually correct, but macro has to lead. And that might mean 6 months, might even mean 9, 12 months before we see that change. But the one thing that you can know with absolute certainty is that the cycles in crypto are not over. There are more cycles to come, and that's something I lose no sleep being confident in.
So the environment for crypto VCs obviously has also been challenging, right? Because if you benchmark to something like Bitcoin, which at this point is like super easy to buy for anyone really, then I think few funds have outperformed that. And I think the sort of the DPI, so the amount of money returned from funds, has mostly not been so great. I think fundraising has been very hard for VCs. Do you think the crypto VC market is going to change a lot, and like how does it need to evolve?
I think it's almost certainly going to change. It's already begun to change. So I think that change has taken place largely because most of the funds that were raised in crypto VC were raised in 2021, 2022. And that was peak ZIRP. ZIRP stands for zero interest rate policies, when all of the central banks around the world were setting their rates to zero or even below zero in many places. And that just meant that money was burning a hole in your pocket. You had to put your money to work somewhere. And that meant a lot of risky capital, or a lot of risk-seeking capital found its way everywhere, into private equity, into VC, into, obviously crypto VC was one of those beneficiaries. So those funds have largely run off now. Usually in venture, you have a 2 to 3 year fundraising cycle, and then you deploy your fund, and then you go raise the next one. Almost everybody who raised big funds during that time is now coming back to market, or they're already back in market. And those funds in 2021, 2022 have been drawn down. So once those funds are over, you see that the next vintage, if you can't raise that amount of money anymore, then you have to downsize. Or you just have to fold. You just have to go, find some other line of work. And that for a lot of VCs, that's the answer, is that it's not just that, they can't raise as big of a fund as last time. So they can't raise at all. If you raised 150 million and now you can raise, 20, those economics mean that you have to fire your whole team, right? You can't run a fund. You can't keep your team. You can't do what you were doing before. And so a lot of people, I think, just quit if they realize that they can't really do that anymore. Now we're in a relatively fortunate position that we have a strong brand, we have strong returns, and there are a lot of LPs that know us and want to continue working with us. But I've seen even a lot of the brands that you know and love really struggling in market to be able to get fund vintages that are even comparable to their previous sizes. You can see for some of the funds that have been announced, significantly smaller than they were in 2021 for a lot of these name brand VCs who've come back to the market. So what does that mean for the industry? A few things. One, it means that there's a lot less money and a lot less froth in investing into companies, both in the early stage and the late stage. Now, that may correct as you start to see other forms of capital come into the space. So if you see more growth capital and more pre-IPO investing, I think that's likely to be actually pretty robust because there's growth capital that's willing to touch crypto now, especially in the fintech stablecoin space. But in the crypto native stuff, that's where it really is just the crypto native VCs that invest into layer ones and layer twos and things like this, DEXs and so on. And this capital is much tighter, and everyone already feels it. So I think what it means is fewer VCs. I think it means more rational pricing. I think it means that founders, the bar to raise money in crypto and to be a successful founder is higher than it's ever been. And many people were thinking that, there's going to be mean reversion. Like it's going to go back to the way it was. Things are going to be hot and crazy again because, alts just haven't moved. And if alts start moving, then everything's going to change. And I think that's actually not true. I think that even if alts start to move and you start to see some of these funds are getting good DPI and so on, the reality is that the environment we had in 2021 will never come back. Like we're not going back to ZERP again, and we're not going back to the amounts of money and the splashiness that you saw in 2021, where deals were getting done with no diligence, super fast term sheets, half-baked ideas getting, $10 million. That is not going to come back, even if asset prices do much better. It does mean that valuations will go up, but those valuations will be fought over by a smaller set of VCs moving at a pace that's more akin to what traditional venture has always looked like.
If you think about it from the perspective of someone starting a crypto company today, also feels like a very different environment, right? Where it's a lot more mature. A lot of things have become very competitive. As you pointed out, the fundraising environment is more challenging. What's your sort of main advice for someone wanting to start a crypto company today? What should they keep in mind, and what has changed about how you should approach this today?
My very glib answer is nothing has changed. The reality is that founding a startup in crypto was always hard. Every single moment that I can remember, it was always hard. Founders never thought it was easy to start companies and to build things in crypto. Even in times in the past, like if you think about 2017, 2018, which was the golden era where a lot of the most important projects were first built, I remember what it was like. I remember how those founders felt at that time. And the answer was that they felt like shit. They felt like it was really hard. They felt like they were struggling to get access to capital. They felt like, the world didn't care about what they were building. And you might think even, 2021 was the party years. That was when everything was crazy. Money was really loose. Everything felt kind of wild and splashy. But even then, I remember when a lot of these companies were raising their seed rounds and they were struggling. And it's just like, yeah, okay, I can get some vanity metrics, or I can get a bunch of Twitter followers, but can I actually get people to use my product? Can I actually go hire a team? Can I actually go, build something that the world cares about? The answer is that it doesn't really matter where you are in the cycle. Building companies is hard. Building products is hard. Just even the act of deciding I'm going to go leave my job, stake my reputation and my future career on the success of this crazy idea that nobody believes in but me. That's hard, and it will never not be hard. So at the end of the day, you don't know where markets are going, and you can't time things, right? Nobody in 2018 was like, you know what, that was a great time to quit my job and go all in on crypto. Turned out to be right. Nobody at the time thought it was a good idea. And same thing in 2021. Turns out that actually it was a terrible time to start a company. Most of the companies in 2021 are failing miserably, and people at the time thought, it's a great time to quit my job and go, do some crazy thing. So the reality is that you just don't fucking know. And at the end of the day, starting a company and going into, building something and staking your reputation on it is an immensely personal decision. And that's where your conviction and your willingness to do it should come from. should not come from, hey, I think the market's good timing, it's this and that, blah, blah, blah. Who gives a shit? You don't know, I don't know, nobody knows, right? If you have a good idea, if you really believe in it and you believe in yourself, go build a company. And if you don't.
Cool. I have 2 more questions I want to ask you about. So
well, hold on. Before you ask me that question, Brian, you are yourself an entrepreneur.
Yeah.
What would you say?
I mean, I feel like just the key is to find something. I mean, I would always use that approach if I wanted to start another company at some point. I'd want to find something that, of course, one, I'm like deeply passionate about, and that I would be willing to keep working on for like 10 years, right? And I think that is one of the things that I wasn't so cognizant when I started Course One, for example, was just that, like, okay, once you go down a road, right? Once you choose something, right? Like, you have to stick with it, right? Like, you have to stick with it for a really long time. So I think that is one thing that I think is like super crucial. And then, I mean, I am personally very like I have a strong instinct of like wanting to go somewhere that is kind of overlooked and ignored and not hot, and where I'd feel like, okay, this is something that will become really big. Which I think a lot of people have the opposite instinct, right? Because maybe a lot of people are very good at execution, and they're like, hey, this is an obvious opportunity, let me go and compete with everyone else. And some people can succeed that way. But I think right now you just see so much copycats, right? It just feels like a vast majority of stuff is, just people saying, oh, this worked over there, let me do the same thing over here. And it seems very short-sighted, right? Because even if maybe you have some initial success, and it's probably a lot easier to get initial traction with a lot of this stuff because, well, it's already kind of worked somewhere and you can replicate it. Then I think that to actually converting to something that like works in the long term, really hard. And I think the other issue I see is I think people are just going to get bored of this stuff, right? And they're like, this is kind of lame, right? The thing I'm working on. And then I think that's the worst thing, right? Because then I think the founders will get bored. It will be harder to hire people, or the people will be very mercenary and kind of come and go and move to the next thing. And so I think and I think crypto has, I guess one of the things we are seeing, which I think is a challenge for the industry, is that it's become more something that people see as, hey, this is an industry where you can make a lot of money quickly. And there are a lot of opportunities. So I think it attracts a lot of those people. And then a lot of people I know, who've been in crypto for a long time, I feel are increasingly not that excited about it anymore. So I think this is actually for the first time, like last year, this year, where I see a lot of people I know who've been around for a long time who are kind of like, maybe I want to do something else. Something like not in crypto anymore. Whereas, a lot of these people were like so passionate and so driven and like so ideologically motivated. And so I see that as a, big challenge for the industry as well.
Yeah, that's very well said. There's a line by Sam Altman where he talks about, when he was at YC, originally he would talk about, a very common advice would be, okay, don't try to come up with some super crazy, extremely ambitious idea because it's just too hard and you'll never be able to tackle that as a startup. And after he came to OpenAI, he said that he realized that he'd been giving bad advice at YC. And then actually, when you pick something that's really ambitious, that's like really crazy, and then like, okay, we're going to build AGI. It's like, okay, it's so unlikely to succeed. It's so capital intensive. It's crazy for a startup to want to do that. But the one thing that you will do with almost certainty is you will attract followers to your cause, because people want to work at a company that's ambitious. They want to go do something crazy. They want to go do something that will change the world. And you will be surprised at the level of credulity that people will be drawn to. And they'll say, like, fuck yeah, I don't know if we'll pull it off, but like, let's try. Let's go try to build AGI. And that is something that's resonated more and more for me in crypto, is that a lot of people, like you said, they try to play small ball. Think like, oh, well, someone did this thing on this exchange or on this chain, so I'll go port it over to this chain. And it's like a very safe approach to building a company. And it's like, oh, probably win. But you're absolutely right. It doesn't attract great people, doesn't attract great investors. And like at the end of the day, the really like the things that really energize people is always first and foremost ambition. And that's what employees want to see. It's what investors want to see. It's what the world wants to see. Like the world will reward you for having an ambitious idea. It might not succeed, but it'll be a hell of a lot better of a ride for you than going and building, the nth Y on a Z.
Yeah, absolutely. I heard this other interview with you where you said that you think discipline was like the most important contributor to your success. Like how do you think about discipline? How would you define it? And what's your advice for someone who wants to become more disciplined?
Oh, damn! This is very like general life advice. I don't know how good I am at this, but I'll give it a shot. So I would consider myself to be a very, very disciplined person. I think I've been that way, not all my life, but for much of my life. I work pretty much all the time. I don't drink anything but water. I kind of eat, work out, follow a regimen very assiduously, and like my ability to stay focused on one task, not just one task, but like one meta task. Not just literally, okay, I'm writing and I'm going to write for the whole hour, but just I'm going to be a great investor and I'm going to learn everything that I need to in order to be a great investor. The discipline to just keep doing that over and over again for years is very rare. And so discipline, I think it's something I intentionally cultivated when I was younger because there's something I knew I didn't have. When I was younger, I was at school, I was a serial procrastinator. I was super lazy. I just played a lot of computer games and kind of didn't really give a shit about a lot of things. And it was something that I really didn't like about myself is the fact that I was very undisciplined. I think I was obsessive when I really, catch my teeth in something. I'm the dog that can't let go and, just gets dragged by the tailpipe by the truck, for many, many streets. So I've always had that quality in me, but being able to intentionally think like, hey, this thing that I don't want to do that kind of sucks, I should just go do it. So I think that is one of the qualities that I have and that also intentionally cultivated myself. And I think if you're asking the question, how do I become more disciplined? I think the answer with all these things is just practice, right? So how do you practice discipline? The answer is, okay, what's something you think you should be doing? How do you create a system that forces yourself to do it? So I'll give you one example. I know that as a VC, it's very important for me to build my public brand, to tweet, to like kind of be out there, right? And over the last few years, I've my voice has very much risen in volume and in having a spotlight within especially crypto Twitter, and that was very intentional, right? It was not an accident that I was able to cultivate my voice in that way. But one thing that most people don't know about me is that I don't read Twitter. I actually block all feeds on my phone. I have a rule: no algorithmic feeds on my phone ever. Everything that I try to do is pull based rather than push based, meaning I don't want to be told, hey, read this, read that, da 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 da. I want to intentionally go and choose. I'm going to read this. I'm going to go look for this information, etc. And so my relationship with Twitter is like literally I block it, block the feed. I have like browser extensions that block all feeds on my browser, and I don't have the mobile app installed on my phone. And nevertheless, I'm tweeting very regularly. I have a rule. I tweet once a day, every weekday, at least once a day, every week. And if I don't, any given day, I have to pay somebody $100. And I've been doing that now for years because the honest to God truth, I hate tweeting. Really don't like social media. But I do it intentionally, cultivate it. And for a long time, the way that I did it is that I would force myself to do it. Right. And like, how do I force myself to do it? The most excruciating thing you can do is to send $100 to your friend and be like, don't donate it to charity. Don't do something good with it. Go waste it on something that's going to really piss me off. And I've been doing things like this for years as a way of cultivating this habit in myself of just tweeting regularly. And now it's like a muscle. Like now I just, I got to tweet today, boom, 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 get it out there and try to write something that I think is going to resonate with people. So this kind of thing, just multiply that by, everything that I'm doing in my life that I find is important. You can do that. Anybody can do that anytime they want. It doesn't have to be $100. It could be $5. But it just has to be like, look, you know the things already that you wish you were doing that you're not doing. And in a way, like, how can you create the one thing that you learn in order to actually cultivate discipline is not about being disciplined, right? Like, one thing that you have to assume about yourself is that you are a lazy piece of shit. That is how I model myself. I am a lazy piece of shit. And the only way that I will do things is if I have to. If I either pre-commit myself to doing it such that I can't back out of it, or I've created a structure that is going to force me to do it, right? It's sort of environmental design. These two things to me are the core of how you ultimately cultivate discipline, is by either making public commitments that you can't go back on, or by creating these structures around you that are going to force you to do it. And if you keep doing those things, eventually people will look at you and they'll call you disciplined, right? And so it's like when people look at me and they call me disciplined, I'm like, dude, that is not how I perceive. I'm a lazy piece of shit. I know myself well enough to know that if all these structures fell away, I would just, I would lie in bed and play video games and smoke dope or whatever. Like I'd be absolutely useless as a human being. So these things come from what you put into it. That's the best answer I can give about how to cultivate discipline.
I think that's a fantastic answer, and it definitely resonates. Maybe just a final one. So do you're someone who's very curious, right? You like to explore different things, learn. I mean, you've had some, very fundamental changes in, your career and focus. Do you think you'll always be an investor, or do you have something in your mind, or like, okay, one day this is what I want to do?
I will always be an investor in the sense that I will always be investing into things. But will I always be a professional investor? I doubt it. I think I'm somebody who I naturally have moved through many different domains in the course of my life, and I'm almost certainly not done. That being said, I'm very committed to building Dragonfly and to investing into what I see as the generations of crypto technology that are still yet to be fully done. But there will come a time when crypto is basically done. Not that crypto is not going to change anymore. There's not going to be new founders or new startups. But if you think about, like, for example, social media really stopped being venture investable after about 2010, right? Now, that being said, social media companies between 2010 and 2025 became the most important companies in the world. Social media won. The thesis was absolutely correct. But there's really nothing more to do as a VC, right? Almost every single social media company was already built before 2010. And so I think that's probably going to be true of crypto at some point. I don't think it's true yet, but it will be true of crypto at some point, that all the most important companies / protocols are basically built. And the growth is going to happen in public markets, not in private markets, the same way that happened in social media. And I think that will be the point at which we say, we were right. We won, right? All the things that you and I, when we first came in this industry, all the things we were saying that nobody believed us, we were vindicated. But there's nothing more to do as a VC. Like, you're done. Hang up your hat, go do something else. I don't want to overstay my welcome as a VC. I don't want to be clinging on and raising funds when I don't really believe that there's still this golden era of opportunities of companies and protocols to be built. I think there very much obviously still is, and you can just see how much Solana just went from nowhere to being a dominant chain in the span of like a year and a half. Like, that just happened. So very clearly, like, we're not done. There's still an enormous rate of change in this industry. But is it going to last 10, 15 years? I don't know. Maybe not. And if not, I will hang up my hat and go do something else.
Cool. All right. Well, thank you so much, Haseeb. It was a huge pleasure to have you on. Really enjoyed the conversation. And
thanks for having me, Brian.
Thanks so much for coming on.
It was an honor to be on. This is, if I had told myself 7 years ago that I'd eventually be on Epicenter, I think I would have been elated. So thanks for having me.
Thanks so much, Haseeb.